Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. Despite the uncertain state of the economy in 2023, characterized by high inflation, the Federal Reserve raising rates, and a struggling stock market, many renowned investors have been actively buying into the market. While most other investors have been selling, notable figures like Warren Buffett have invested significant amounts of money in the market. This trend of buying during weak economic periods has proven successful in the past, such as during the crashes of 2020, 2008, and 2001. These instances highlight the effectiveness of this strategy. Mohnish Pabrai, a disciple of Warren Buffett and a close friend of Charlie Munger, who once paid a hefty sum to have lunch with Buffett, recently outlined 3 essential rules for succeeding in this approach. The secret to finding great stocks during recessions. One important investing rule, especially during periods of high inflation and economic weakness, is to seek out companies that possess a lasting competitive advantage.
Let's say you have some small city in England and it has no Thai restaurant, for example. And someone looks at it and say, I think Thai restaurant do really well here. They open a Thai restaurant and they do really well and they're full all the time and they can charge premiums versus London and other cities. That is going to attract more people and more entrepreneurs to open Thai restaurants until eventually the economics of the Thai restaurants in that small city may be no different from other parts of England. The nature of capitalism is such that if someone builds a better mousetrap, which, grows a company and generates high returns on equity and very profitable and so on, they have a target on their back. And in general, that will attract a lot more competitors to enter your space. And they'll try to chip away at whatever advantage is there.
It's crucial to understand that being the first in a particular market or innovation may lead to initial success, but it doesn't guarantee long-term dominance. Examples like Snapchat, which pioneered stories but eventually lost its edge, Atari, the first in video games but eventually lost its lead, and Motorola, the initial producer of mobile phones but eventually lost its dominance, highlight this fact. Instead of focusing solely on being a first mover, investors should seek out intrinsic qualities in a business that permanently differentiate from competitors. These qualities create a moat, a unique advantage that cannot be easily replicated by others, no matter how hard they try. The importance of identifying and understanding such moats is increasingly apparent in today's business landscape. Big Bad Brand Moats. It may seem counterintuitive, but businesses with highly desirable brands actually possess the strongest moats and are considered excellent investments, especially during challenging economic times. Having a moat means that customers consistently choose their product or service over alternatives, even when finances are tight. People are willing to prioritize these brands over cheaper options. Ferrari serves as a prime example of a company with a brand moat. Despite the presence of cheaper cars and supercars in the market, the demand for Ferrari remains consistently high. Similarly, brands like Louis Vuitton are not necessarily known for their superior product quality, as they are made from similar materials as other products. However, customers are drawn to these brands due to their reputation, design, logo, and what they symbolize. Nevertheless, it's important to remember that no moat is permanent and everlasting. No moat is forever. In addition to identifying a moat, it's essential to continuously monitor its longevity over time.
The nature of capitalism is that moat is very likely eventually to get filled in. So if we go back in history, you look at businesses that have survived and thrived for a long time. Very few businesses that are founded make it past their first year. A few will make it past their 5th year, and even fewer will make it past their 10th year, 20th year, 30th year. It just keeps going down. When we look at businesses that may look dominant today, our job as investors is to project what these businesses may look like 5, 10, 20 years from now. And that is a very difficult exercise because you have all these marauding intruders who want to take away your moat, who want to take away those profits, and they're continuously coming at you. That's what makes this a fun and exciting endeavor from my point of view, because trying to figure those things out is not that straightforward.
While Apple is undeniably a formidable company with a significant brand moat and switching moat, it's crucial for investors to continuously assess the strength of the moat. One way to identify such moats is by following Phil Town's exercise, which involves examining the long-term performance indicators such as revenue, earnings per share, free cash flow, and equity. A key aspect to consider is whether the company demonstrates consistent annual growth of over 10%. In the case of Apple, although the chart appears favorable, it's important to acknowledge that equity can be distorted due to share purchases. Nonetheless, Apple seems to possess a moat as they have sustained uninterrupted growth over a prolonged period. Conversely, declining sales, shrinking margins, negative media sentiment, or store closures can indicate that the moat is being compromised. In summary, the first significant lesson is to seek out businesses with enduring moats. Coke, less popular than Pepsi? In the following clip, Mohnish discusses a type of moat that's consistently impossible to replicate.
Now, sometimes what happens in capitalism is we get aberrations. When this pharmacist started the Coca-Cola company, he had no idea what he was on to. And no one could have imagined that Coke would end up being the brand it is today. And actually, quite frankly, there's nothing particularly magical about Coke in the sense that they say they have the formula locked up in some bank vault in Atlanta. But it's really easy to clone Coke, and several companies have done that. When Pepsi introduced the Pepsi Challenge in the 1980s, they basically gave people 2 colas to drink with no brands on them, and they said, tell us which one is better. And most people preferred Pepsi because it was a little sweeter. And then after they took the test, they would tell them, oh, by the way, you preferred Pepsi. But if they presented the 2 drinks to most people with the brands, Coke and Pepsi, most people would prefer to take Coke. So Coke's moat is, if you look at it kind of objectively, it really doesn't make any sense. They have a product that can be very easily cloned. They have competitors in many cases who have better products, but a brand got built.
Indeed, we frequently observe that the most potent moats often revolve around brands. Mohnish's point holds true. Coca-Cola, for instance, was objectively shown to be less favored than Pepsi when the labels were removed. However, when the iconic Coca-Cola label is present, it becomes the undisputed #1 drink globally. The secret to buying stocks cheap. Our strategy involves holding on to these businesses for an extended period, mitigating a significant portion of long-term risk even if we happen to make a mistake in our valuation. By adhering to this approach, we can effectively manage and minimize potential losses in the long run.
The second approach is where you identify a great compounder that, because of people not willing to look at the right time horizon, then you can look around the corner. You could pay what would be either a reasonable or even an expensive looking price and end up with a great result. I think you could have paid any multiple for Microsoft when it went public in the 80s, almost any multiple for Walmart when it went public in the 70s, and you would have still done extremely well. So if we have a crystal ball that can tell us what a company might look like 50 years from now, 30 years from now, then, we could buy something at $1 billion market cap and it might become 200 billion.
The significant advantage of this type of strategy lies in its ultra-long-term focus. By investing in high-quality businesses with substantial moats, there's room for flexibility in valuation. Even if these businesses are purchased at a relatively higher price, their potential for substantial growth and increased value over a span of 10 to 15 years remains intact. This doesn't imply disregarding valuation altogether, but rather emphasizes the potential to achieve success by purchasing high-quality businesses at a fair price, rather than solely seeking out bargain deals. Warren Buffett's investments in companies like Coca-Cola and Apple serve as prime examples of this approach, where substantial returns have been realized over time. Our biggest advantage. Now let's shift our focus to another essential element described by Mohnish.
So one of the arrows in our quiver as value investors is patience. So in general, we don't really have, for the most part, an information edge. So if I'm looking at a business, there's not much I'm going to be able to come up with about that business that a lot of other people haven't figured out or are capable of figuring out. Then there can be another edge, which is an analytics edge, which is 2 individuals have the same information, but one person is able to look at that data and come to conclusions that are different from the other person. And so an analytic edge can be a real edge. But even that is difficult because there's a lot of smart people looking at a lot of companies. The one edge that is probably the strongest is the time horizon. And even Jeff Bezos says that a lot of his competitors are focused on the next 1, 2, or 3 years. And he said that Amazon always took the approach of looking out longer, looking out 5 or 7 or 10 years. And he said that when they looked out longer and they invested with that longer time horizon, they got an edge. And they were willing to make investments where they knew that the payoff is not going to come in 3 years.
This principle applies not only to the companies themselves, but also to us as investors, emphasizing the significance of a long-term outlook. Mohnish highlights how it becomes our greatest advantage as value investors who manage our own funds. Unlike active funds driven by short-term performance targets, we're not pressured to achieve immediate high returns. Instead, our approach is rooted in patience and a focus on long-term value. We seek out excellent companies during favorable times and then simply wait. It may not be an exciting or action-packed strategy, but it's a game of patience and relative inaction. We patiently wait for the crisis to subside and the recovery to take hold, regardless of whether it takes 1, 3, or even 5 years. By exercising patience and holding on to these exceptional businesses for the long term, we ultimately reap the rewards.
So I think, yes, the ability of an investor to think longer term. And this is one of the reasons why the index does so well. The index is too dumb to know that it owns Microsoft. It's too dumb to know that it owns Alphabet. And it's too dumb to sell these things. And it keeps these things endlessly forever. So we look at the S&P 500 index, for example, which is 500, for the most part, great businesses. And every year, they might take 1 or 2 businesses out and replace them with 1 or 2 new ones. But usually the ones they take out are not the ones that are climbing. Like recently, they removed General Electric from the Dow Industrial Average. And if you look at the Dow Jones Industrial Average over time, in general, you get rising stars going in and you get companies that have passed their prime being taken out. The S&P 500 would hold an Apple or a Microsoft or an Amazon or Alphabet for 20 years, 30 years. And that type of holding period on these great businesses can be a great edge.
It's indeed remarkable that the S&P 500 index outperforms more than 90% of active fund managers in the long run. This serves as a compelling example of how short-term mindset can hinder an investor's performance. Instead, we focus on investing in businesses that have demonstrated proven moats, recognizing the importance of a long-term perspective in achieving success. The not-so-secret formula. Indeed, this is the not-so-secret formula that value investors utilize to thrive amidst challenging economic conditions. Firstly, they search for companies that possess unique intrinsic characteristics that distinguish them and give them a competitive advantage. Secondly, they adopt a long-term approach by holding onto these companies for an extended period. Lastly, they avoid succumbing to panic and selling their investments prematurely, recognizing the importance of allowing the investments to compound and generate significant returns, untapping the long-term potential. However, it is crucial to note that Mohnish raises one more vital point that we must always keep in mind after discovering a significant winner. Let's hear what he has to say.
There are very few businesses in the universe of listed companies that would qualify as great businesses. Probably, I would say less than 5% or 3% of listed companies would qualify as great businesses. If you find yourself in the very happy situation of fractional ownership of one of those businesses, hang on for dear life. This is one of the biggest mistakes I've made over time. Guy owns a stake in Ferrari, thanks to Mohnish. Thank you, Mohnish, for giving Guy the Ferrari stake. And Mohnish doesn't own Ferrari. And when I made the investment in Fiat Chrysler in 2012, when the market cap was $5 billion and their sales were $140 billion, Fiat Chrysler was trading at less than 4% of revenue. And 80% of Ferrari was inside that $6 billion. And plus there was all the Jeeps and Ram and Maserati, everything else in there. And at that time, Pabrai funds owned something north of 1% of Ferrari when I looked through the Ferrari stake. And we made a lot of money on that investment. And one of the dumbest things I did was Ferrari looked optically expensive to me. And I sold, and we would probably have 3 times that amount of money if I just kept the position. And like Charlie says, old too soon and wise too late.
This is the final piece of the puzzle. Once you have identified a business with a wide moat, committed to holding it for the long term, and acquired it at a fair price, it's essential to not let go of it unless there are significant changes in its fundamentals or if it becomes extremely overpriced. Instead, allow the business to fulfill its potential over a span of 10 or 20 years, benefiting from compounding growth as demonstrated by successful companies like Amazon, Google, and Tencent. The key to achieving significant returns lies in resisting the temptation to prematurely sell promising investments while actively managing and eliminating underperforming ones. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.